Good afternoon, everybody. My name is Onyeka Alimele. I'm an investment consultant and a finance expert. Today, I want to contribute to what you may already know or something you may not know. And the information you will receive today is something that will benefit you a lot, either right now or sometime in the future. So it is a very important information for anyone who is into financial market investing or who is looking to invest in financial products. Because financial products are not always advertised by banks and derivative brokers in the exact way they work. So there are so many hidden functionalities and mechanisms inside financial products that even as a professional investor, if you are not well grounded or you are not well advised by a sound finance expert, you might think you are investing in a golden structure or a golden product, but the result at the end of the day may not be something that you would like. And some of us who have already invested in financial products in the past, you can relate to what I am talking about. So knowing about how to identify a good investment opportunity in financial markets is a very important critical topic that you should know about so that perhaps tomorrow you are faced with an investment opportunity, you know how to guide yourself rather than just relying solely on that bank trader who is advising you to buy the product. So if someone is advising you, you should know exactly, have your own professional information and marry it with what the advisor is telling you to see if whether what he is saying is going to benefit you or not. So how to identify a good investment opportunity in financial markets. This is our topic for discussion today. Okay, so the very first thing you must know is that the investment opportunity must be a financially regulated activity by the world's best financial regulators in the US, UK, Canada, Schengen countries, Australia, United Arab Emirates, Singapore, Japan, and Cayman Islands. I specifically picked these countries because you will save yourself from a lot of headache and sleepless nights, and you will help your health condition better if you stick to investing in financial markets only within these countries, and not just in these countries, but the investment opportunity presented to you, the product presented to you must be regulated by the financial market regulators in these countries only. So it is very important for you to know who are the financial regulators in these countries and make sure that the product you are investing in, the broker you are investing in, is regulated by the financial market regulators in any of these countries. So in the US, you'll be looking at the SEC, Securities and Exchange Commission. You'll be looking at the NFA, the CFTC, and then in Canada, the IIROC. In Australia, it would be the ASIC. In the UK, there would be the FCA. In Dubai, it should be the SCA and the DFSA only. And then in Cayman Islands should be CIMA, CIMA. So you have to know who are the financial market regulators in these countries and only participate in investment activities that are under any of these regulators. It's very important. Number two, the investment opportunity must clearly spell out all the risks associated with it. It's not enough for you to just blindly trust your financial advisor and he will just tell you, invest in this product, invest in this, without giving you specific details about the risk associated. Because even if you are able to create a risk-free trading strategy in financial markets, there are still other market risks that will surround that product. So the trading strategy itself may be risk-free, but what about the other risks like technology risk? It can happen. What about credit risk? The risk of the bank or the derivatives broker you are dealing with going bankrupt, which can happen. So even liquidity risk, volatility risks can happen. So the only risk that a very good trader in financial markets can mitigate and come up with a solution whereby it becomes risk-free is the market price fluctuation risk. So that is the only risk you can conquer in financial markets. That is, you can be able to trade in a way through a sophisticated hedging strategy and through structured products. Banks call it 100% capital protected notes. So they can create a product whereby if the market moves up, you make money. If the market goes down, you make money. They can also create it in such a way that if the market moves up, you make money. If the market goes against you, you don't lose anything. Your capital is protected 100%. They can also structure a product where your capital will be protected up to 70%, 80%. But I'm trying to tell you that these products that are 100% capital protected, they are only risk-free based on market price fluctuation risk. That is the only thing conquered. But there are still other risks that are associated with investment products, like liquidity risk, the technology risk, the credit risk as well. So the risk of the investment opportunity must be clearly explained to you. If there are things that are hidden within the investment opportunity and they are not clearly defined in terms of clearly telling you what the risks are, then you know there's something fishy about that investment opportunity. Do not invest your money. The third one is the trading strategy of the investment opportunity must be explained to the investor. It is very important because it is not good to invest in a black box. So you must know what you are investing in. You must know if your financial advisor is telling you that this product is good, this product can earn you 40% returns in a year, blah, blah, blah. He should explain the trading strategy, the trading logic to you as an individual so that you can judge with your own human intuition whether I would like to invest my money in this way or not. So it may sound interesting in terms of the result that is being presented to you, but the trading strategy itself may not be something you would like to really invest your money in. So by the time you know, like they say, the devil is always in the detail. By the time you get to know about how the trading works, how the product works, if I buy at this position and the market moves up, what is going to happen to my money? If the market goes down, what is going to happen to my money? What if the market stays flat until expiry? What is going to happen to my money? You have to know how the product will work so that you know whether there is something that the trader is trying to hide from you, which will eventually manifest by the time the product starts running during the product useful life, so that you don't end up getting surprised, suddenly about, for example, you can buy a structured product, and when you buy a structured product, they may not tell you about the MTM. That's what they call mark to market, which is the MTM. So you may not know how the MTM of the product works. So you, on paper, what they tell you, for example, those of you who are exposed to advanced financial products like accumulators, they just write it very simply for you. You know, they explain it in English, and it looks like you understand how it works. No. No. In reality, by the time the trade is placed, when you log into your portal and you are looking at the MTM of your account, you may be totally shocked. Why am I losing $10,000 all of a sudden? It's because you do not know how the product works. You think you know because they're giving you a paper to read and it's in English, and you read it and you thought, yes, I understand it, this is very simple, it's just like this. No, you have to know how the trading strategy works, how the product works. They have to explain to you the profit and loss of the strategy. Number 4, the investment opportunity must have a verifiable track record. Now, you know how the product works, they've explained to you, you know what to expect, you're not going to be surprised, in quotes, but you should ask for one thing. There should be a verifiable track record, an audited report of that strategy, of that product. You must ask your banker. It is important for you to ask him, ask that professional, is this strategy, this investment opportunity you are presenting to me, has it been done somewhere before? What is is there a verifiable track record? Now, in some cases, the strategy or the investment opportunity or the investment product may be a new strategy that is just created, that is just newly discovered. Now, in those kind of cases, you should be satisfied well enough about the mechanism of the product, how it works, about the details of the MTM of the product before you invest in that new opportunity that has not been tested. So knowing about the details of the product, how it works, and then you are satisfied that this investment opportunity, if I put my money, I know what to expect, I'm not going to lose money, or I'm going to lose money but not to this extent, and you are happy to invest in it, then you can invest in that new opportunity. But if it is not a new strategy, a new idea, then you must ask for a track record. If the person tells you he has been using this strategy for 6 months, I've been trading like this, I've never lost money for the past 2 years, show me your track record clearly. An audited one, not just something manufactured. It is very important. It will save you from a lot of headache. Number 5, the investment opportunity must have a trading strategy that is based on downside protection against losses. Now, this is the most important aspect in investing in financial products. The trading opportunity, the investment opportunity must have a trading strategy that is based on downside protection. Listen, don't ever invest money in speculative activities. Don't ever invest money in speculative trading, in speculative products. A product that is predicting market direction, a product that is naked, like we say in finance. Don't invest in a product that does not have a downside protection against losses. Now the product is telling you we are predicting that stock prices will rise in the next 5 years. And so we are entering at this entry price and we expect the market price to rally to a certain price, and then we will lock in our profits and we are done for that investment opportunity. What if it goes wrong? What if the market does not go in that direction? What if something happens in the global market and the market takes the other direction? Then you start losing money. So there should be a downside. You should ask your investment advisor, what if this strategy does not work exactly the way you are explaining it now? What happens to my money? You must know if the investment opportunity does not have an alternative way to protect you from losses, do not invest in that opportunity because it is classified as speculative. Only invest in investment opportunities with strategies, hedging strategies. A speculative strategy means that you are taking a market view. You are only buying or you are selling. But a hedger does not care about market direction. A hedger buys and sells at the same time to protect his money, and this is how banks are able to create those 100% capital protected notes. So they buy and sell at the same time to lock in your money so that no matter what happens, you can never lose your money. The money will always be available to return back to you, no matter what happens in the market. So these kind of ideas should be your focus as a financial market investor. Only invest in strategies. There are strategies where you will have, I have one myself. I created one myself. It is a no drawdown delta hedging strategy, whereby no matter what happens in the market, you don't have a drawdown. If the market goes up, you make money. If the market goes down, you make money. These strategies are not everywhere in the market, but they are available. There are, good financial advisors who have some of these strategies. Put more of your attention in strategies that have downside protection, and you save yourself from a lot of sleepless nights. Lastly, the investment opportunity must have an agreed residual value. That is the maximum level of capital loss where the investor can opt out of the opportunity if that maximum loss is breached. So the investment opportunity must have a residual value, an agreed residual value. So in the event that you are not able to find, you are not lucky enough to find an investment advisor with a strategy that can protect your money fully, and is telling you the strategy I have, it will only offer you 80% capital protection or 70% capital protection, then you should be satisfied as an investor that, yes, I am happy to take this risk of saving 70% of my money and losing maximum 30%. And you should ask him, how would this be possible so that I don't lose beyond 30% of my money? He has to explain to you, and let me tell you today for free. If he's telling you that he is going to invest, the strategy is all about creating a structure, a portfolio with futures and with Forex and sport and all of that, and protecting your money with a stop loss, no, it is not the best way to go, because stops in financial markets are not guaranteed. If the market spikes very hard against your stop loss, your closing price will not be at your stop loss price. You will exit from the market at a more disadvantaged price. And by that time, you will lose more than the 70%. In fact, it is even worse if the investment strategy does not have a downside protection at all. It is worse. And a lot of hedge funds are running with strategies, investment strategies, that don't have downside protection. They tell you there is risk, they just tell you the risk and all of that, and allow you to invest blindly. No, money is too precious to throw away. You have to have, if you cannot protect your funds fully, then you should partially protect your money. Don't leave your money to chance for the market to just keep going against you and you wipe out your account. No, that is not the way to go. So you should have an agreed residual value of your equity so that when that value is breached, you know it is time to opt out of this opportunity. You tell the banker, you tell the advisor, no, I don't want to invest again in this product. No, my deal is done, and I think I'm done with this opportunity. So this is very important for you to know. When you follow these 6 rules, you will not have sleepless nights. You will be able to sleep well at night. You will not be thinking about your investments. You allow your investments to run peacefully, and you will be a happy investor. Thank you very much.
Thank you for your presentation. Any questions from the audience? Yes, please.
I have a question regarding risk. Yeah, you mentioned that we all the time need to ask about risk. Yeah. How we can be sure that our person who will be investing will be providing all risk? How we can identify all risk of investments?
So yes, it's a very intelligent question. Now, every investment product or trading strategy have their own peculiar risk. But there are general risks associated with all types of investment products in financial markets. I will list them to you now. Number one, market price risk, which is the risk of you taking a particular view in the market. Maybe you're expecting the market to go up, and then so you place a buy position, and if the market goes against you, which market falls, you start losing money. So that is price fluctuation risk. But how to counter that and protect yourself against that is to buy and sell at the same time. So that if the market goes up, what you will see all the time about your equity is that one side will be losing, the other side will be making profit. So that is called hedging. Are you getting it? So that is market price fluctuation risk. You must ask him, what is the plan to counter this? If he doesn't have a plan for this, it's not a good investment opportunity. Don't invest in it. Number two, volatility risk. Volatility risk is the risk of prices spiking suddenly. You just see a price, Tesla is trading at $200 per share, and suddenly you see it at 250 or 300. So that is volatility. So now even if you have a stop loss at a particular price, if the market spikes, even during weekend when the market opens with a gap, it will be executed at the next available price after your stop. So that will make you lose more than you're supposed to lose. So you must ask him, that volatility risk, what is the plan to counter that? Number three is liquidity risk. Now you want to exit. You see that Tesla is running haywire, and you don't want to get involved in the market anymore. You want to close out your position, either take the profit at that time or take your losses and just exit. Now you are calling your banker, close my position and let me take out my money. He's telling you, we cannot exit now. There is no liquidity in the market and all of that. No. So liquidity, you must ask him before you invest in that opportunity, what is the plan to take care of liquidity risk so that at any time I want my money back, I can exit my position and take out my money. You get it? Number four is technology risk. The risk of the bank machines freezing suddenly, which can happen. Prices can freeze in the market. So, and if there's a technology breach or something is happening technologically, even the trading software, some people use AI to trade today. AI can go haywire, you know. So even the VPS you are using to run in your run your machines can have some malfunction. So those technology risks that can happen, that can make you lose money in that investment, you should ask your manager, what is the plan? If he doesn't have plans for these basic risk, do not invest money in that strategy.
Thank you.
Thank you.